Hi, this is Suzette, and we'd like to welcome you to another episode of the Meaningful Multifamily Podcast. And with me today is Brian Coddington and Charles Duncan from the Source Advisors team. Last time we had the honor of having them on the podcast with us. They did an awesome presentation about cost segregation, and today they are going to do a presentation on energy efficiency studies for tax purposes. So without further ado, I'm going to go ahead and let them take over. You guys take it.
Thank you, Suzette.
Thank you.
So before we get into the podcast, in case you missed us last time, I'd just like to introduce ourselves. My co-host is Charles Duncan. He founded Source Advisors cost segregation practice back in 2003, and he's the senior technical director over cost segregation and our energy efficiency studies areas, which is what we're going to be talking about today, what they are, how they can help you for tax purposes. I am Brian Coddington, and I recently rejoined the Source team. I started my career here back in 2002, and I work in the area of tax accounting methods and credits, a whole bunch of stuff with inventory and fixed assets and all sorts of fun stuff. So before we dive in too deep, we're going to talk about what this podcast is really about. And the tax code, the federal tax code that is, gives us a lot of wonderful incentives to do favored behavior. Favored by whom? By Congress and the administration, the ones who have passed the laws. And we're going to be talking about two of them. These are two complementary tax benefits. One of them is a tax credit, and one of them is a deduction. And if you remember our podcast from last time, you may remember that credits are usually favored by taxpayers because if you get a $20,000 tax credit, your taxes go down by $20,000. But if you get a $20,000 tax deduction, well, your taxes only go down by how much your tax rate is. So it's not worth dollar for dollar what a tax credit is.
But it's still favorable.
Oh, yes, definitely still favorable. And so today we're going to be talking about the code section 45L tax credit for new energy efficient homes. And we're also going to be talking about the code section 179D energy efficient commercial properties deduction. And even though one's a credit, the other's a deduction, as we'll see in a few minutes, these really are complementary programs. Where one leaves off, the other takes over. Even though how you get there and what you have to do to calculate them varies widely. It's all based on an idea of modeling the energy savings for a building and determining whether that building, or if we're looking at apartments, a particular apartment unit qualifies by meeting energy saving standards. This is part of the green building initiatives that Congress passed into law back in the mid-2000s. And we're just going to go real quick, try to keep it conversational over just what is 45L, how do you know if you're eligible? If you are eligible, what's the process to get the credit like? Then we're going to repeat the same thing with 179D. And so what is 45L? Well, it's a tax credit, and it is a subsidy. It is a tax expenditure where Congress has said, we are going to incentivize taxpayers to make energy efficient residential housing. And, we're not going to talk about everything it does, because 45L, it just doesn't cover energy efficient homes. It covers apartments too. Also covers manufactured housing. And it incentivizes these not by, giving you, the taxpayer at home, an incentive. Here's a certain amount of tax credit for buying an energy efficient home. It incentivizes the developers, the manufacturers. So it gives the eligible contractor, as they're called, the company that has manufactured energy efficient mobile home, or the developer who has constructed an energy efficient apartment complex or tract housing. All of this stuff is what's incentivized. It's on the producer side, in other words. And as I mentioned, it's a credit. So you get a dollar for dollar offset against taxes owed or paid in the tax year that the property is sold or leased. And we say sold or leased because, if you develop, a subdivision of homes and you're selling them off one by one, well, some may be sold off in 1 year, others in the next, or 2 years later. And so you get a tax credit when you sell them to an end user who's going to use them as a residence. Same thing on the apartment side. When you lease an apartment, that's when you get to get the credit. And that's you as the developer of this building. And it's a great opportunity because it's a $2,000 tax credit per dwelling unit. And if you can't use it in the year you get it, well, you can carry it back 1 year and you can carry it forward 20 years. So there's plenty of opportunity to use it if you aren't able to, because your taxes are too low in the year where you've leased or sold a qualifying property. And Charles, what did you want to say?
So I can't remember if we're going to have a slide to this point a little bit later in the presentation or not, but there's a logistical issue that comes into play here. Because this is a credit that benefits the developer, there's a timing issue with when the developer leases or sells the property and to whom they lease or sell it to. If a developer builds an apartment complex and sells it to another company which is going to manage it, and that new company is now the owner, and they're the first ones to lease it to the end tenant, that developer has missed out on the opportunity for the 45L tax credit. So the developer really needs to own a piece of this at the point in which it is being sold to the resident or leased to the resident, not at the point in which it's being sold to a management company. And that means there should probably be, if there's an opportunity here, there should be conversations early on that may determine what sort of structure that developer is building this under, and eventually selling or leasing it under, so they can take advantage of that. Once if this is not done properly, they have completely missed out on the opportunity.
That's an excellent point. And yes, that is a very real issue. When we say an eligible contractor, we don't necessarily mean the general contractor who physically constructs the development. Instead, we mean the owner who hires a general contractor and who actually owns the development and has tax basis in it during the development process. And that's a difficult analytical situation. And if you are a developer, then you probably need to talk to your tax advisors to see, okay, I know I'm making green buildings out there.
Mm-hmm.
I'm pretty sure they're going to qualify. I need to get with my tax advisors to see, am I leaving this credit on the table because of my business processes, or because I am not structuring things correctly? And of course, there are competing concerns. Some things are structured in some manners because there are legal reasons or regulatory requirements. So it may be something that you're not able to get.
Sure.
But
yeah, you don't want the tail wagging the dog in a scenario like this. But nonetheless, it's worth being aware of the issue so that someone can make an informed decision.
Oh, definitely. And we'll get into that a little more later. So this slide shows us, well, why are we talking about an entire development? Can I get this for constructing a single home? Well, yeah, you can, but it's still $2,000 per dwelling unit. And so, it's possible to do it, but if you're constructing a single energy efficient home, it may not be worth it because it's only $2,000.
I guarantee you it won't be worth it. The cost of the study doesn't pay for the credit at that point.
Yeah, that is true. Now, a housing development, an apartment complex, a condo development, where you have many units that you're building at once, that's where you start to get into situations where it will pay for the study.
Mm-hmm.
And we're going to get into in a few minutes a description of just what's involved in the study. There is actual work. It's not just documenting, okay, here is the info you've given me, and oh yeah, I see it's energy efficient according to whatever, it qualifies. No, there's actual work, energy modeling, things like that go into a study, actual certifications, that makes it difficult to perform the work. It's not something that a typical CPA firm would be able to handle. Now, as you can see here, we're giving you examples. And you may note that all of these properties have one floor or two floors, or at most three floors, and that's because there's an important limitation. The 45L credit is only for buildings that have 3 or fewer stories above grade. And we'll actually get into what that means in a couple of minutes. But as you can see from our example here, it's just a straight $2,000 per unit credit. If you have 100, you could get $200,000. If you have 200, it doubles.
But the table on the slide is a little bit misleading.
Mm-hmm.
In my example here, we're showing 100% of the units in the housing development qualifying, or 100% of the units in the apartment complex qualifying. The reality is more nuanced than that. When an engineer or rater goes out and physically tests the property, in addition to modeling the property using software, they may find that some of the units qualify and some do not, and this may be due to the particular method in which the units are constructed, with some having better R values in the ceilings, there's other units on top of those. It can also depend upon the orientation of a unit within the overall property. Units that are facing in one direction and get a greater heat load from the sun may not fare as well in the modeling as others that have a different orientation. So it's not unusual within a given housing complex or apartment complex that some units will qualify and some will not. Another thing that we routinely run into is because most developers are building to local building codes, and those codes differ widely across the nation. In certain regions or localities, the properties are more likely to qualify against these federal standards, which are governed by certain engineering ratings or engineering standards, versus other parts of the country where the building codes aren't the same, and the property developers aren't held to the same standards. And so, again, some cities we may see a lot of properties qualify, and other ones we may not.
Excellent. That's definitely true. In some ways, it's a lot like how we think about solar panels. In San Diego, they're a great idea. In northern Alaska, they're not a bad idea for part of the year, but there's a large part of the year where they're just not going to work. But moving on to eligibility. So you have to, this is a threshold issue. You have to have constructed new dwelling units that meet the energy saving standards. And like I mentioned before, you have to own and have basis in the property during the construction. And finally, you have to lease or sell the unit to a person for use as a residence. Now, we could get into what that means, but you're not here to, go through the finer nuances of, well, do I really have basis? And generally speaking, if that's a concern, you need to ask your tax advisors, am I going to have basis in this? And when I say you, I mean your partnership, your corporation, whoever is developing, whichever entity is developing the property. So it may not be unusual in some cases for a general contractor and a developer to enter into a partnership that will own and develop an apartment complex, and then they cash out at some point down the road. Perhaps when it's leased, or perhaps when they sell it to a third party to operate and to lease it out. But like Charles mentioned a few minutes ago, if it's that last situation where they're selling it to another company to lease it out, well, they've missed the boat on 45L. It's quite a sad situation. But there are a lot of heuristic ways to tell if you qualify. And Charles, can you, for people who are familiar with construction, can you tell them what they need to be looking for or what they need to ask their contractors about to see if they might qualify?
There are some rule of thumb for potential qualifiers, and it's worth noting that this rule of thumb may change in the near future as new tax legislation changes the standards against which we have to test against. But for now, air conditioning or heat pumps with a SEER rating of 13 or higher, or at least an 80% AFUE furnace, that's a good indicator that we may qualify. If there's minimum R values of the insulation, R13 to R19 of the walls, R21 ceiling, R38 roof. If there's low E windows, insulated exterior doors, insulated foundations and slabs, these all tend to lend themselves to helping the property qualify. If there has been no effort along these lines, if you're really not striving to build an energy efficient building, then it's unlikely that you'll qualify. It's not the easiest thing to qualify if you're not actually deliberately building an energy efficient building.
But because of local building codes, they may inadvertently qualify, right?
Yeah, good point. That speaks to the point I was making earlier. There are certain parts of the country where we have a pretty high expectation that a new development will qualify if you just build to the local code, because that local building code is specifically oriented towards energy efficiency or energy efficient construction.
And there are other situations where even if the building code isn't oriented that way, you can still end up with an energy efficient development. We've seen throughout the country that certain low income housing that qualifies for the low income housing tax credit, because of how those can be awarded, it's often better to have energy efficient buildings. And so those frequently will qualify. So there's always the possibility that even if you don't know that you're building an energy efficient building, you really are. So we're going to be talking about single family or multifamily dwellings, and they have to be 3 stories or fewer above grade. And so what we're really talking about is affordable housing, apartment buildings, assisted living facilities if the units have kitchens. And you can look down a couple of bullet points and you can see that same thing applies to dormitories and other student housing. We have to have buildings where you can meet all of your dwelling unit needs. You have to be able to eat, bathe, sleep, all of those things in your dwelling unit.
And it's worth pointing out here, I think, that there's a bit of a disconnect between what is defined as a dwelling unit or housing for purposes of 45L versus what is residential real estate for cost segregation. There's certainly overlap. An apartment complex for cost segregation purposes, which has its own particular class life, will also be in the running for 45L. But there's other building types such as dormitories, which are nursing homes, which are generally considered residential real estate for purposes of cost segregation. But for purposes of 45L, they may not be because of the lack of kitchens. 45L is based on engineering standards, and those engineering standards have their own separate definitions of what is commercial real estate versus a dwelling.
And so it is possible that something will not qualify for 45L just because there are no bathrooms or kitchens. It seems a bit ridiculous, but it's how the engineering standards are written, and it's based off those standards. So, yes, Charles.
No, I was just going to say, it's not really ridiculous in the sense that these are just 2 separate standards that don't speak to each other. But for purposes of 45L, when Congress wrote it into law, they based it on engineering standards as opposed to the cost segregation standards that we otherwise use in our practice.
Right, of course. So who doesn't qualify? The big category that we see, big 2 categories, are the developers that sell apartments before leasing them out.
Mm-hmm.
Another big category is the general contractor who doesn't have an ownership interest or basis in the dwelling units. And very frequently, the general contractor is in the best position to know whether something's energy efficient, but they don't get the incentives. It flows to the owner who's hired them in that case. The student and assisted living facility type housing, those come up, but they do not qualify for 45L. And then finally, and this can be a big problem in many urban settings, mid-rise developments of 4 or more stories above grade, they just don't qualify for the credit. Now they can qualify for 179D. So not all is lost, but they don't get the credit, which is generally preferred to the deduction.
So Brian, why would, and I already know the answer, but you'll answer it better than I am. Why would an all suites style hotel of 3 stories in height or less not qualify, even if it looks identical to an apartment complex?
Well, the reason, it's a pretty simple reason, is that while people are using those as a residence, it's only on a transient basis. You're going to be there for, you know, a week, 30 days, whatever. That's the immediate situation. But it's also due to the engineering standards. And they tell me that some of those they don't fall under the same rules, that there are hotels, and they even extended stay hotels are different from apartments.
Exactly. So in this slide, we like pretty pictures. So we thought this would kind of help illustrate some of the scenarios. Obviously, based on what we've already said, a 1-story or 2-story home is going to qualify if it meets the energy standards. There's no limitations it's not hitting those height limitations. A 3-story apartment complex would also qualify. And the next example, we have a 3-story apartment complex that's over an above ground parking garage. Almost unintuitively, it qualifies that above ground parking garage, even though in this illustration it's showing a 4-story building, because that parking garage is not occupied space for purposes of these energy standards, the rules that govern this, that is not counted. And all we're counting are the occupied floors above that. So this example still indicates a 3-story building. It just happens to be on top of a 1-story above ground parking garage. The next 3 examples are showing some classification or some building types that would not qualify. A 4-story apartment complex, even though this is residential, and for cost segregation purposes, it's still residential. But for 45L, it doesn't qualify because there's more than 3 occupied stories above ground. What would happen here is that instead of applying 45L, we would then fall back on Section 179D energy efficiency study and try to pick up a tax deduction from that. The next example is for 4-story mixed use. We get the same answer. And then the last example here, that's the tricky one. Is this 4 stories above ground or not? And the answer is sometimes. When we're looking at a property, maybe it's in San Francisco where you have these split levels. We look at the partially buried levels, and we have to do some math here to determine whether or not 50% of the wall is above ground. If 50% of the wall is above grade, then we have a 4-story building in this example, and it would not qualify. If not, then it may still qualify. So there's some analysis that has to be performed in some cases.
Yes, and we have to fall back on good old-fashioned geometry, which fortunately, that's not me. The engineers take care of that, and I think everyone wants it that way. So tax issues, your least favorite part. So if you're in alternative minimum tax for the year, you do not get to take the credit. You can carry it over to other years, but if you're always going to be in alternative minimum tax, then there really isn't an opportunity in general. Another issue is, well, you could just be a passive investor. And if you have insufficient passive income streams to offset the credit currently, it might take you many years to monetize it. And while that is still useful, it may, lessen the appetite for the accompanying study that you need. Um, if possible, if you're not just a passive investor and that you are in fact a real estate professional, you may consider looking into that status and determining whether you can combine activities and whether it's worthwhile to do so to be able to take the credit. And finally, of course, if you develop something and you sell it to someone who's going to lease it out, you will have lost out on the credit. And you probably should have the new owner lined up beforehand, before you sell it, during the development phase, so that they can have their own, you can form a special purpose entity to be a partnership that has ownership and basis throughout the construction process, and they're able to claim the credit. And that, of course, all of these things, you need to talk to your tax advisors to see what is best in your actual situation. So what's the process? And Charles, can you walk us through what goes on in order to get the building to qualify for the credit?
Sure. I'm not going to go into a great deal of detail here, to save on time, but it's a multi-step process. It begins with reviewing the drawings and specifications and generating energy simulation model. And we'll talk about different model types on the following slide. That is followed by on-site verification and testing. And this on-site verification testing is required under the tax code. We know there's some practitioners out there who try to make up excuses for why that's not necessary, but it is written into the code that this is a requirement. And what you can see in the picture to the right is part of what's called a blower door test, where the HERS rater is visiting the property and they are testing how well sealed the property is. And yes, the HERS rater has to lug that equipment all around the country as they perform their work. And then then we've had the final analysis, which is the real energy modeling and the certification. And we have to you use IRS approved software, which compares these the improvements that we're testing against what are called ASHRAE standards. And Brian, if you go to the next slide, please.
No problem.
Okay, so there's three primary software packages that are used. I understand there may be other ones that are currently being developed or are seeking approval, but basically Ecotrope, Energy Gauge, REM rate are the main ones. And the engineer will literally create a model within the software package of this particular property to determine whether or not it qualifies. And again, that model is compared to the on-site testing that we saw on the prior slide.
All right.
Well, go ahead, Brian. I was going to tee you up.
Oh, okay. Well, that takes us to Section 179D. Section 179D is a deduction. So it's not, dollar for dollar, it's not worth as much as credit, but it's still very valuable. And it achieves many of the same goals as 45L. And it, in many ways, picks up where 45L leaves off. If you don't qualify under 45L, we look at 179D. And that is based on the energy guidelines, the engineering standards. If you don't qualify for a tax reason, we can't fall back on 179D. You're just out of luck in that situation. So way back when, now, the Energy Policy Act, I believe in 2005 or so, created this deduction. And it's a deduction for the owners of commercial buildings and for the designers of government-owned buildings. So it's a twofold deduction. not only does the owner of, say, your standard mid-rise office building get it, potentially, but if you are a firm, say that does a lot of development in the green building space for your local or federal government, you too can potentially get the deduction if it is assigned to you. And that can get really complicated, which designer qualifies, but for the sake of the presentation today, just know that it's out there. And since most of our listeners are probably going to be investors and building owners, it's not something you have to worry about. Now, how do you identify it? So commercial, we're looking at a 4-story or taller apartment buildings, auto dealerships, hotels. I'm not going to read the slide to you. And design firms, well, schools, libraries, courthouses, offices, state universities. And that's a very key point. State universities will qualify. The local junior college, the state-supported junior college will qualify. But your private schools will not. Even though they're tax exempt, they aren't government owned. And that's the key point, is that for design firms to get the deduction, they have to be working on government owned. Just tax exempt ownership is not enough.
Right. So for instance, a church, which is, tax exempt, would not qualify. However, if that church is leasing their space from a property owner of a commercial real estate, that property owner may actually be able to qualify for 179D.
And that's a great example that it's the owner. If you have a tax-paying owner, that's who's going to look for the qualification as 179D or 45L. So Charles, can you walk us through just what qualifies?
Okay, so within each building, we have 3 categories that may qualify for some portion of this deduction. It's on a square foot basis. So for a fully qualifying building, we have the lighting, the HVAC, and the building envelope. And if you exceed the energy standard by the right amount, then you'll get 60 cents a square foot. For partially qualifying buildings, individual systems, for a fully qualifying building, you may get up to $1.80 per square foot. We see a fair number of those, but more often than not, buildings are only partially qualifying. And in particular, we've been seeing the lighting qualify, where because the standard that we're applying against is, kind of predates the advent of everyone lighting their buildings with LEDs, for instance, that almost any new construction that has LEDs, which after all, almost every building does, could potentially get the lighting portion, or 60 cents a square foot. The HVAC, also we see a great deal of success qualifying that, because it's no longer even legal to buy an HVAC system that is as inefficient as the ones that were being sold prior to the current standard. So we do see many properties qualifying for that. And the building envelope is probably, at this point in time, the more difficult of the standards to meet, simply because at the time that the standards were written, we already had pretty good R value insulation and windows and such.
And that brings up an important point. Recent legislation that was passed at the end of the year, or actually the beginning of this year, I believe, has changed 179D. It is a permanent deduction. 45L, it's only good through the end of 2021. And then Congress will have to extend it again, which most likely will be the case. 179D is a permanent part of the tax code. And in case, you're wondering, well, what makes it worth it compared to a tax credit? All of these things, the general building, lighting, HVAC, and envelope, are depreciated over 39 years. By getting to deduct their costs up to the limit of either $1.80 or 60 cents a square foot, you are accelerating all those tax deductions from over the course of 39 years down to 1 year. So it's a very useful incentive in that regard.
Well, let's talk about the math on that a little bit. So if we are able to identify $100,000 in deductions, what it really means to the taxpayer in terms of taxes that are offset is simply that $100,000 multiplied by the tax rate. If we say it's a 40% tax rate, then that would mean of that $100,000, $40,000 of taxes would be offset in the current year. And that's why it's not quite as valuable as the dollar for dollar credit of 45L, but you don't really have a choice. You're either going to qualify for 45L or 179D. If you do qualify for 179D and you get that tax deduction, it's still really, really valuable.
Mm-hmm. And so, as you mentioned, there are a lot of easy ways to get the lighting to qualify. Can you walk us through what this interim lighting rule is?
Sure. There's two ways to qualify for lighting in under 179D, and we talked about the first way on the prior slide. There's also the interim lighting rules. If you're unable to qualify for the partial deduction in lighting, we can fall back on this as an alternative. So it's based on the lighting power density calculation, which is in watts per square foot. And a 25 to 40% lighting power density reduction equals to 30 cents to 60 cents of tax deduction. To qualify for this, the property must incorporate things like bi-level switching and automatic shutoff in their lighting. I looked at a property earlier this week actually, and was looking exactly for this, and unfortunately they did not have that bi-level switching or automatic shutoff, so they were not going to qualify for the interim lighting.
Interesting. So for eligibility for tax reasons, you have to be a taxpayer. I mean, you have to pay federal taxes. If you're a design firm, you may have issues with your shareholder or partner basis limiting your deductions, and that's a complicated issue, and you would need to talk to your CPAs or other tax advisors about that. Now, when can you get it? That's an interesting point. If you're a design firm, you can look at generally speaking, at the past 3 years. If you aren't taking it on the most current tax return, you can amend the 3 prior years to claim it. If you're a building owner, on the other hand, you can go all the way back to the mid-2000s when it was enacted, and if the building qualifies, then you can get those deductions. And it's been such a long time since it's been part of the tax code that at this point we're starting to get to the point where it's almost not worth it to go back all the way to the beginning. But it still is. It still is right now. But in another couple of years, it won't be, just the way the math usually works out. So when we're looking at buildings, new construction, renovations, and additions, all of those can qualify. We don't want nonprofit-owned buildings, though if it's a taxpayer that's leasing it to a nonprofit, that's fine. And the projects in which your firm is primarily responsible for the design, that's if you're a design firm leasing, building government buildings. So
I'd say that there's one caveat on the prior slide. It's true that a renovation of an existing building may qualify due to other provisions in the tax code, which we touched on in our prior presentation. For many renovations, there's actually a more advantageous opportunity in terms of what's called qualified improvement property. Something we look at on the cost segregation side. And so for many renovations, looking at 179D may not make sense this year. The code's always kind of fluctuating. In other years, that absolutely makes sense. So it was just something we have to keep an eye on to give the taxpayer the most advantageous opportunity possible.
That's definitely true. And the reason it doesn't make sense, I mean, take lighting. If you redo all of the lighting in a building, you go to the latest LED standards. That probably would qualify for some partial deduction. But that lighting also qualifies as qualified improvement property, which right now gets 100% bonus depreciation and can be written off entirely in the current year. So looking at 179D is, well, you wouldn't. But when the bonus rate drops below 100%, like it will in a couple of years, or when you're looking back to a year where there wasn't 100% bonus, or it wouldn't have qualified as QIP because QIP didn't exist. In those situations, 179D can be very valuable.
Absolutely.
So, Charles, what does the process for 179D look like?
Well, and to be fair, this isn't the best slide in terms of process. The process again begins with, it all begins with modeling. That's, with everything that we're talking about, modeling is the starting point, and you have engineers that are using software packages to model those properties. The process then you follow up with a site visit, just as we did with the 45L. In the case of 179D, that means photographing to document how the building is built out, looking for those bi-level switches, for instance, and other motion detectors, and taking light readings in every single space to make sure that we're meeting the right standards for illumination in the most efficient way possible. And what we end up with here, and these are really examples to illustrate what we get after following the process. So if we have a commercial client that has built a high-rise residential structure, in this case 42 floors, so clearly it's not going to qualify for section 45L, and has an area of over 800,000 square feet, so it's quite a large structure. Let's look at the HVAC qualification. Well, if the difference in annual energy cost is, in this case, it's $145,000, the achieved savings over the reference is 15.9%. And that reference is, again, it's an ASHRAE standard, which is a national engineering standard. The 179D deduction, in terms of dollars per square foot, it was 60 cents per square foot. And the total deduction, since it does qualify, it's meeting that ASHRAE standard, in this case is $480,000 just for the HVAC alone. Now, we also are going to look at the interim lighting in this case. So the reference lighting power density is 0.7 watts per square foot. The actual lighting power density is 0.4 watts per square foot. So there's an achieved savings over the reference of 42.8%. Again, the 179D deduction is 60 cents a square foot. Multiply that by our 800,000 square feet, and we end up with a 179D tax deduction totaling of $489,000 in this case for the lighting.
That's excellent. So now we've reached the end of our presentation. If you have any questions, please reach out to us. You can contact our colleague, Al.Schmitt, whose contact information is on the slide, to set up a discussion with us. And I do have to apologize, Al could not join us today, but please feel free to reach out to him and would be happy to discuss any of these issues with you. Charles?
I don't have anything else to add. Thank you very, very much.
It's been a pleasure presenting today. And Suzette, if you'll rejoin us. Yes, there you are. Thank you.
Hey, so wow, that was an awesome presentation. I do have a question about the 45L. So I noticed that in one, like in the 45L, it had to be three stories or fewer. And then in these 179D, it was 4 stories or greater.
Mhm.
For housing, correct.
For housing. So that's very interesting. And so in the 45L, is that just, and you guys were talking about developments, does that can that be applied towards remodels of apartment buildings of 3 stories or fewer?
It can be, but the engineers assure me that it is much, much more difficult to qualify in those cases. As I understand it, you'd practically have to take them down to studs and rebuild everything from the ground up well, not from the ground up, but rebuild it substantially to qualify.
Mm-hmm.
And
the problem is the 45L guidelines are very strict, and a big part of why a building would qualify for 45L is because of how well sealed it is. You know, the walls, the doors, the windows, and how well insulated those the walls are, the ceiling, the roof, the slab even. And in a typical remodel of an apartment complex or a condo or dormitory or whatever the case may be, it's very unusual to open up the walls and re-insulate, to add new vapor and moisture barriers to seal it up. In some cases, we may see a property owner replacing windows, but even that is relatively rare. So if a building was built in the 1980s to a much earlier standard, even if they do a pretty significant remodel of it, it's generally unlikely that it's going to meet the newer energy standards.
Okay, well that helps a lot. So, wow, you guys are just a wealth of information and valuable knowledge. I'm just like so excited you guys were able to, go in deeper into, the 45L and the 179D. These are all, new, no, it's all new to me, but wow. And I've just to let you guys know, that last episode that we did together, that just was really well received, and
oh, good.
It's still getting attention. So whenever you guys have something else to share, please do reach out, and let's get the information out there, because knowledge is power, and we definitely want to provide value to investors of commercial and multifamily. And I just really appreciate you guys and for bringing this information. So hopefully we can come up with some more content to bring to light.
You're very welcome, Suzette. And again, I'll reiterate what Brian said. If you do have any questions, please feel free to reach out to us. That we're really, obviously, we're perfectly happy to talk all day long about these topics.
Nice. Thank you so much. Okay, well, thank you so much for joining us. I will get all of this information posted. If there's any resources to go in deeper regarding 45L or 179D, you can go ahead and forward that to me, and I will put everything in the show notes. Thank you once again. I will go ahead and stop the recording.